And before we start, here is a small risk disclaimer for you guys. The information provided in this webinar is for educational purpose only, and should not be considered as financial advice. The content presented in this webinar is based on the information believed to be reliable but not guaranteed is made as to its accuracy or completeness. Pure Prime and I shall not be held liable for any losses, damages, or expenses incurred as a result of the use of the information provided. Trading and investing in financial markets involve a high level of risk, and it is possible to lose all of your invested capital. Before making any investment decisions, it's important to carefully consider your financial situations, investment objective, and risk tolerance. All trading and investment decisions are solely your responsibility. Participants should be aware of the risks involved and only trade or invest funds that they can afford to lose. So here's the risk disclaimer, and then without wasting any time, we are going to start our webinar right now. So in today's topic, we are going to discuss about the trading indicator. So in today's topic, we will talk about what is technical analysis, have a very brief understanding of what is technical analysis. And then we will try to introduce and educate you a few famous indicators that you utilize from the global traders, which including the moving average, which is very simple for us to understand, but quite effective. And then we will have the RSI combined with the MACD. So this RSI as well as MACD, right, when we are going to prepare our daily market analysis report and post in the website, on technical fronts, we will normally use the RSI as well as the MACD. So let me show you the example. So if you go to our pages, normally every day we will update the latest market trends for everyone. So when you go to our pages, if you click the research pages, or sometimes account manager might send you the daily market analysis report. So when you notice on the report, there should be some of the fundamental analysis combined with the technical analysis. So in today's webinar, we will try to also let you understand what is the indicator tools when we are utilized when we conduct the reports. So you will be able to more understanding on it. So you can notice that this is our daily market analysis reports, and every day we are going to update it, or your account manager might be also send it to you. If not, you can refer to our website. And then this is a very short market summary, letting you guys to understand what happens around the markets recently. Short form it, have a very clear vision for you. So you don't have to go through multiple different media in order for you to understand each product one by one. And then you can also notice that in market movement fronts, we do have the dollar index. In the market movement fronts, you can notice that we do have the dollar index, and then we will normally conduct with a short fundamental analysis, and then we will do some technical analysis. Technical analysis should be very simple. We are just utilize two indicators, including the MACD as well as RSI when we conduct the technical analysis. So if you just read through and go through here, it might be a little bit confusing for some of you. That's why in today's webinar, we will let you understand what is MACD indicator and what is RSI indicator. When something happens around here or around here, what can we expect next? So this is something very key topics that we will also discuss later on it. So in future basis, when you refer to our reports on website or some of our reports from Telegram, you understand it from MACD perspective, what you expect and how can we understand the analysis inside our article. So we hope that it can enhance your trading journey further. And then we will also talk about the moving average. Moving average is also very simple, which we are going to talk about the possibility of the trend reversal. When the trend reversal is going to happen, we can utilize the moving average for us to understand the market trend. Okay, so for new traders, some of you guys might be not sure about what is technical analysis. So it's very simple. For technical analysis, it's just a charting tools. And then by using the charting tools and trying to understand the historical movement in the markets, we were able to predict something that the price might be same in the future basis. So for example, maybe we can look around the crude oil markets. You can notice that if you are going to utilize the crude oil markets and then by using the weekly charts, by using the technical analysis, we understanding that 68.20 is a very strong support level. And then each time when the prices reach here, it might be rebound back, reaching here, it might be rebound back, and same. So what do you mean by this? It's like we are trying to utilizing the historical movement with the expectations that every time the candlestick hit 68.20, it might rebound back. And then now we might be expect the same thing. So this is what we call the technical analysis. We try to understand the historical movement, and then we are trying to expect this historical movement might be happens again in future. So this is how we utilize the technical analysis, and then we will combine with the indicator. It's mostly like charts, but we are using historical price movement as well as volume to predict potential repeated trends. So we need to understand the market sentiment behind the market, behind price trends by looking for pattern and trends, because it's quite different for you to analyze crude oil compared to company. Company should be simple because we need to, when we want to do some company valuation, we need to understand how much this company is going to worth. It's so-called the intrinsic value, and then we can calculate the share price. So when you're analyzing the company is over there. You can try to calculate the potential clients, how much this company is going to earn annually, and then what is their cost, what is their debt, and then we discount back. And then we understand that this company worth how much, for example, 1 billion, 2 billion. This is something like we can utilize, like do a very solid predictions. But it's quite different when we want to predict some trends such as the crude oil. Crude oil initially, or for example, gold initially, it don't have any intrinsic value. So we're not sure. Every one of you might be very confusing about the gold price. Some of you guys might think gold price should worth 3,000. Some of you might think gold price should worth maybe 1,000, 2,000, because there is not a very, very specific intrinsic value for you to calculate the gold. Gold don't have a long intrinsic value. Normally, the gold prices is based on the market speculation as well as market expectations. So for example, currently the gold price is around 2,777, which means that a lot of market participants think these prices is cheap. It doesn't mean that gold price is actually worth this kind of value. And we can't calculate the intrinsic value for the gold as comparison with the company. But if we are going to go through the company analysis, right, we understand that, for example, this company, every day they do have 100 of customers who enter his shop. Then each customer might be spending around 1,000. Then every month or every day, this company able to gain how much of the money. So it's very easy for us to forecast the company valuations. But what if this kind of commodity products is difficult? That's why sometimes we need to utilize the technical analysis for us to understanding what is the global markets participants are thinking about it, and then we try to adjust on it. Because as a retail trader, how is it possible for us to understand what is the institutional investor are thinking? So by utilizing the charts, we understand, for example, crude oil. A lot of institutions might think crude oil 68.20 might be very, very cheap. They force and buy on it. Every time it reach here. But of course, there is some things happens like any potential breakout below the support level, and the prices might be changes. So this is the thing that we will discuss next time, but not now. As for now, we will try to utilize the indicator and then predict the prices, whether it might be going up and going down, simplify for you. So here is the basic understanding of what is technical analysis. So you need to understand technical analysis is more than just a chart. It's just utilizing the historical movement to predict the future movement. We are trying to think the historical thinking that the institutional investor, the retail investor are thinking on, and then we are trying to predict that this thing might be happens again in future. Okay, so without wasting time, we are going to talk about our first indicator, moving average. So moving average is a stock indicator commonly used in technical analysis, helps to level the price data over a specific periods by creating a constantly updated average price. It seems like very, very confusing, but it's just simple. It's just a line like this. After you utilize the MA line, you can notice that we do have 20 MA, 60 MA, 200 MA. It's just a line. But this line, how can we generate this line? This line is generated by the average price of the candlestick. So for example, yeah, this 20 MA line means that we are utilizing maybe 20 candlestick closing price, and then we divide them and calculate the average. It's simple. It's just like we predict the historical 20 days movement. Then it will come out with one number, right? So this is the MA, and then every day it change, then MA line will be formed. So to understand in a very simple term is 20 MA line is by utilizing the 20 candlestick, but 60 MA line is by utilizing the historical of the 60 candlestick. 60 candlestick means that it utilizes a longer term candlestick. For example, if you are analyzing the day chart, time frame is daily. If you are trying to click 60 MA line, which means that this average price, right, it will be utilizing the 60 candlestick average price, like 60 days of the candlestick pattern. So it's a very long term, and then 200 is 200 days of the average prices. So in the layman's term, is 20 MA line is for us to understanding the short-term movement, 60 MA line is mid-term, 200 MA line is longer term of the movement. So after you understand the basic of this MA line, we need to understand how can we open it, and then how can we actually utilizing it to set the support and resistance level and trying to predict potential trend reversal in the market trend. Okay, so I give you one of the example. Maybe we can try to utilizing the MT4 and MT5 too, and we can maybe try to analyze the crude oil. Some of you guys might utilize a lot of MT4. Later, I will also guide you about the trading view on how to use it. So we remove all the indicator first. So if we want to add the indicator, no matter you are using MT4 or MT5, you're able to open it by clicking the insert indicator, custom. It's under trend. You click the moving average, you click it, then you can click here adjust period 20, which means that you are trying to predict the historical 20 candlestick movement. So you can change your favorite color, but you need to memorize it. I changed to maybe blue color is my short-term candlestick or the 20 period of the candlestick. I click OK. The line will be formed. Okay. And then you utilize the same method. You click insert. And then you go through the indicator. And go to the trend. Same thing. And then you can just click moving average. And then here is the 20 period of the number, right? So you change to 60. And then you change to your favorite color. So you just click it. Once you click it, you click OK. Then the line will be formed. So the key criteria is after we creating this MA line, right? How can we utilize it? So first thing, as I mentioned just now, it can use to predict potential trend and signal reversal from crossover, and then we can use it as support and resistance level. But it's a key reminder that even though sometimes the indicator show maybe it's a bullish bias pattern from the indicator, but it might be changes because this is what we call the lagging indicator. It's like we are trying to use the historical price movement, but future will be changed every time and risk still remain. So it's not 100% guarantee of it, but that's why sometimes you can try to combine with multiple things. For example, candlestick pattern. What should we expect from the macroeconomy or the fundamental fronts? What can we understand on it? And then for etc. For example, US elections is going to happen. And then no matter how good is the indicator as well as the candlestick pattern, but due to the US elections, fundamental storyline is going to shift the market movement. So it can just enhance your trading tools, but of course it's not 100% of accuracy for you to do it. So here is how can we utilize the MA line. In theory, when both line cross, short-term line is above, long-term line is below. It's what we call the bullish crossover also over. And then when the long-term line is above, short-term line is below, it's the bearish crossover. So here seems confusing, and then here I'm going to show you the proof. So as I mentioned, right, just now we do create a 20 MA line, and then we also do create a 60 MA line. And then we understand 20 MA line maybe is a red color, and then 60 MA line is a green color. So when you notice that when previously this short-term line or the 20 MA line is normally below this long-term line or the 60 MA line one, it's keep below and then forming. Then afterwards, this 20 MA line break above or cross over the long-term line, which is what we call the 60 MA line. You can notice that the trend is actually increasing aggressively. So this is the power of the MA line. So when there's a crossover, a lot of investors might be entered here, and these things happens. You can notice that if you long, then you can generate a significant profit. Then if they cross over below again, then it's a bearish signal. So another example should be around here. So normally the red line is above 1, but once the crossover happens, 20 MA line break below the 60 MA line, short-term line break below the long-term line to continue to drop further. So this is a chart, but let's move on towards the real-life example. We have been noticed one of the very practical real-life examples should be on the crude oil market. So here is the best example you can notice on it. So previously, right, around 2023, July 13, the crossover happens around here. So previously, overall trend for crude oil is actually quite pessimistic, bearish one. So once just like we said, the blue line is a short-term line, the red line is a long-term line. If you forget, and you can move your cursor over here, then you just right-click. You can see that when I nearby this blue line, I right-click, you can see that MA20 property, which means that this is historical 20 candlestick average price, is a shorter term movement. And then we move back towards the red color, my cursor, and right-click. This is a 60. So it's a longer term line. So when the short-term line previously is above 1, and then there is a crossover, the long-term line break above, which means that there are trend reversal things might be happen. So any chances that when blue is below, then after that blue become above, break above, and it's a bullish bias. Short-term line break above is a bullish bias. Then afterwards, trend reversal happens again. When this short-term line break again below this long-term line, then it's a bearish bias. Then break again is a bullish, break again is a bearish. So it's things like that. If you're able to utilize this, you might be catch a few good trends. But just a kind of reminder, later I will show you some of the bad example. That's why you don't fully trust with this indicator. You can combine. You need to combine with the fundamental candlestick pattern. And later I will show you the bad example. So this is a very good example. And then overall is a good example. Gold do have some of the bad example. So for example, you can notice that. Here is some of the example. Let me zoom in for you. This is a H4 chart for the gold market. And then you can be noticed that normally, right, this straight line is a short-term line. It's continuing to going up. And then normally when there is a break below, it might be going down and trend reversal, right? But you can notice that even they break below, then afterwards gold start to rebound back and break above again and continue going up. So it cannot fully determine this is a very, very good trend reversal candlestick pattern. Because why is that happens? It's because even though according to the charts indicator, it's good for us to maybe expecting gold might be dropping further, but fundamentally gold price are too strong already. There are too much fundamental support for the gold market to continue going up. Especially you guys understanding that in November we do have the US elections, and then Middle East tensions still remain, and it's going to stoke a shift in sentiment towards the safe haven demand like the gold markets. And then we also understanding that the US central bank might be cutting interest rates. This is something all of it. Other central bank, not only US, maybe EU, UK is going to cut the interest rates. When cutting interest rates, the demand for money might be declined. Investors might shift their portfolio towards more worthwhile asset classes. They don't want to hold money because lower interest rates. So they put their money into the gold market. So even though from indicator price it's good for us to short, but due to this strong fundamental, it's violate it, and then it's continue going up. So this is why it's better for us to combine multiple indicators on it. But this is how we utilize the MA line. And then of course, MA line can also consider as what we call the support and resistance level, as I mentioned just now. So the first thing I assume you already understand. Any chances there is a breakout of the MA line, short-term break above the long-term line is a potential trend reversal. And then you can also utilize this line to understand this as what we call the support and resistance level. Very simple. Each time this candlestick able to draw until this any red line or even the green line around here, you can consider long because it's a very strong support level. So they continue going up, but once the candlestick break below this line, you can consider short. And then once again, they break above again, then you long. Something is like that. You just use the support and resistance to see whether you want to buy or sell. So for example, now I repeat again. Here is one of the example. So if this candlestick break above the red line, because if I zoom in, should be clearer. So you can see here, it's a very clear trend. Normally, right, this candlestick is below this red color line, right, which is what we call the long-term line. So candlestick drop, then you don't do anything. Once this candlestick successfully break above, like see that normally this candlestick is below this straight line. But afterwards, once this candlestick break above this straight line is a breakout, then the trend going up. So what is the maximum cap that you can be expecting on? We are aiming the resistance target maybe around here. So once they reach here, you TP. And that's why you can notice that some of the investors already decided to TP once they reach this line, the green color line. So once they break above again, you can see that it continues going up. So this is how we utilize it as a support and resistance level. So here is one of the example. Normally the candlestick is above this straight line one, but after they break below this line, this here is a breakout. Once they break below, they drop. See, this is how we analyze it by using the MA line and predicting the potential breakout. One moment. Okay. So after you understand it, maybe we can try to predict the gold trend by using the MA line. It's not worth for us to focus by like if you want to analyze the gold, right, by using the MA indicator, it's not very good because you need to wait until any potential break below this straight line. But due to fundamentally, the gold are too strong already. So even sometimes indicator is good, but due to fundamentally gold are too strong, it's difficult for us to do some trend reversal candlestick unless everything has been settled down, the US reports have been released, US elections have been finished, then you can focus back on the indicator. Okay, so I hope I clarify how you utilize the moving average prices. The next thing we are going to move on is the RSI. RSI is very simple. So detail about the RSI, I'm not going to teach you what is the calculation of the RSI or what. I'm going to teach you how can you open the RSI tools and how can you utilize it. So it's very simple when you use the RSI. So you just click insert. RSI. Okay, you go to insert indicator. And then you click go to custom. And then you actually do have the RSI below here. So once you click the RSI, the line, this thing will be coming out. Let me show you. This will be coming out. And then you don't have to change everything. You click OK. So when you click OK, RSI have been fully formed. It's a simple analysis for RSI. For example, any chances this RSI is above 70, it's what we call the overbought territory. There might be a chances for it to drop back. But gold is not a very good example because, as I mentioned, fundamentally the gold prices are too strong already, the fundamental storyline. That's why even indicator is good for any potential trend reversal, but things might be different. So maybe we can try to analyze with the oil markets. Then let me show you. Okay, so any chances, right? This RSI is reaching around 70. 70 means here is above a top around here. There will be a chances to it to drop back. Because when RSI hitting 70, which is this region, it's what we call the overbought territory already. So market already over purchased it, overbought it. Too much people buying it. In future basis, they should be selling on it. So when this thing happens, overbought happens, it might be dropping. So imagine you are from here and then you short, you can be profit from it. So let me show you the line. Here, it's the line. You can see that? It's clear. These candles, this RSI reaching 70, and then trend will also have been formed, then it's dropped. It's dropped a lot. And then here is the first example. The second example is around here. Let me show you. You see here? Overbought. And then afterwards is drop back. I overbought a few periods already. Afterwards it's drop back. So this is how you utilize the RSI. Every time it reaches the overbought territory, you're expecting it might be dropping back. And every time they hit the oversold territory, which means that oversold. Oversold means when they hit here, the below the 30 here. So when they hit here, it's oversold. Oversold means too much people are selling it already. In future basis, they might be purchasing it. And when oversold happens or below here, this should be your entry point or long positions. Okay, so it's very simple. You just focus on this 17 and 30, and then you try to analyze whether they are overbought or oversold, and then you do your potential trading strategy on it. So of course, Here is a good example on it. You can notice that when this RSI have been reaching 30, you can see that the 30. Even this look nicer, but the concept is same. You just focus on 30 and 70. So here is also 30 and 70. You can notice that. So this is by using the trading view. It's showing things like that. So you can see that when this blue line reaching this 30, trend will also have been formed going up. But there is a lot of bad example. You can also notice that here is a bad example. Here is a good example. It's a very good example. You can see that when they're reaching the overbought, here they drop, hitting our expectation. When it hit the 70, the above one, it might be dropping back. But of course, I'm not going to show you 100% of indicator. It's impossible to have 100% of the indicator in the world. So of course, sometimes I need to show you some of the bad example. Here is a bad example. You thought it's already oversold, then you buy from here. But you can notice that afterwards, oversold have been formed. They don't go up, but indeed, it's dropped back aggressively. So it's a bad example. As I mentioned, sometimes fundamental fronts might be provide a significant impact on it. So even though it's already oversold, overbought, but due to some fundamental things, it continues to follow its trend instead of trend reversal. So this is how we utilize the RSI. And then you can notice that in our daily market analysis report, for example, we should be writing things around here. One of the examples is dollar. Dollar is trading lower while currently testing the support level. And the MACD, I will talk about it later. But while ISI is at 49, it's suggesting the index might be extending its loss after its breakout since the RSI retreat sharply from overbought territory. You can be also understand from it, which means that when it reach the overbought is around here, right? It might be continue to drop. So it's already dropping. When the downward trend is happening, we should be expecting it might dropping further lah. Drop until this RSI reaching this 30, which is the overbought territory. So when they reach here, then maybe a short position should be closing. So the situation here should be similar. RSI is at 49, and then it might be continue dropping further because RSI retreat sharply from this 70. But since it's haven't reached the 30, RSI 30, the over so here, it might be have potential to continue dropping further. So this is how we understand it. But of course, it doesn't mean that you should short the gold dollar right now, because we do have a lot of high impact reports which due to release later this week. So indicator is good, but don't 100% trust on it. So you can notice that other is also we are trying to using the RSI. So RSI is at 73, suggesting the commodities might enter overbought territory, which means that there might be potential for the gold prices to drop. So this report we saw in the morning, and then as for now, gold prices actually dropped a little bit, but not fully. As I mentioned, indicator is indicator. Fundamental fronts still have a lot of things to affect the prices. Okay, so I hope I make you a clear understanding about what is RSI from here. And then next, as well as the last one, we are going to talk about the MACD. MACD is actually developed by Thomas Asprey, one of the very famous mathematicians. And then normally, how can we utilize the MACD is by notice on the histogram, crossover, and divergence. And histogram, crossover, and divergence is the example of it. So you can notice that we do have the histogram. Histogram is something like this one. You can see that. And here is what we call the histogram, no? And then we do have the line, the blue line, the red dot line. But normally, I believe that if you are trying to just focus on the histogram, it should be good enough. But of course, you can be also focus things like the potential crossover lah. So this same logic with MA line, it just MA line we apply in the candlestick, but in MACD, MA line we apply in the below the indicator front. So any chances that there is a trend reversal happens, short-term line right below the long-term line, it might be dropping back. Okay, so you can also utilize things like that. But MACD is very simple for us to understanding it. Maybe we can try to utilize the trading view, show you better example. So when you notice here, yeah, first I'm going to teach you how to use the histogram one first. So histogram is very simple. When you notice that, let me show you here. You can see here is the blue color one. It's above 50, above 0 is a green color one. And this green color is what we call the bullish bullish momentum histogram. So when this green color become higher and higher and higher, right? Normally the price will be continue higher and higher and higher on. Okay, so this is what we call the bullish momentum are increasing according to the MACD. Then afterwards, you can notice that it's dropped back. This green color become light green already. It's higher, then it's light green means it's dropping back. So also dropping slightly. Okay, so when they become higher and higher, it continue going up. So you can just utilize the MACD to predict the potential momentum of it. So for example, if you don't want to, you think it's too risk already, you think bullish momentum is too strong already, then you can monitor around here. You can see that this is a very small bullish momentum, but it's continue to increasing. So you decide the momentum might be increasing. So you consider the long. So it's a very, very good opportunity for you. Okay, so you can utilize it, but MACD is a little bit not 100%, not very accuracy, but you can use the MACD to predict the bullish divergence, the divergence strategy. You can combine with the divergence strategy, should be much better and easier. Later I will show you what is divergence strategy. So it's very simple. When the histogram like green color become higher and higher, bullish momentum are increasing, which means it might be going up. And then when this histogram become lower and lower, which means that bullish momentum are declining, the prices are going down. And if the histogram is below one, it's what we call the bearish momentum, the short, the selling momentum. So when the selling momentum going down and going down, it means that it will be dropping further. A lot of people are selling on it until things finish and then going up back. Okay, so this is the histogram analysis and the MACD analysis, what we call. So let's move back towards the PowerPoint. You can see that this histogram is going up, which means bullish momentum are increasing, the prices are going up. And then when the trend is going down, the bearish momentum, the histogram below here, keep going down and going down, which means that the bearish momentum are increasing, is going down. So when we are preparing our daily report, we will also write like that. The first one is, however, MACD has illustrated diminishing bullish momentum, which means that according to the indicator, the buying power is already start to decline. Bullish momentum is like buying power. The chances for dollar to drop should be higher. So it's how we analyze the report on it. Okay, suggesting the commodity might enter overbought, which means also dropping. So this is normally we try to simplify for our clients. So we try to use a simple indicator to explain for you guys. But of course, it's not 100% on it. You need to combine with the storyline above here with the indicator or the technical analysis. Normally, the first paragraph is our fundamental analysis, the storyline in the market. Second paragraph is explaining the charts and the indicator tools. Okay, so yeah, continue. After you understand the momentum, now we are going to focus on the key things. It's what I call the divergence. Divergence, normally we will try to utilize the MACD one. So we do have the bullish divergence and bearish divergence. Everything is very simple. It's like you need to monitor on the candlestick pattern, and then you need to monitor on the MACD also. So for example, if the overall candlestick pattern is a downward trend, but MACD is an upward trend, then you need to follow the MACD, and then you can focus on long positions. Explain like this might be very, very confusing. Let me show you the real example. Okay, so you can notice that this is a candlestick. Overall trend keep continue to going down, right? But MACD here, this line become upward trend, which means that this line, you can see that the previous low is much lower than the current low. Bullish line. So when things happen, you long, you can consider long. And you wait until this blue line turn curve, yeah, then you only consider long. Then it might be going up. Of course, when you need to seek confirmation, highly advisable for you to wait until this line turn curve. So if this line don't turn curve, like when it reach here already, like keep going down, then you thought bullish divergence already formed. But if it haven't turned curve, then it might be keep dropping until it's no more bullish divergence. Okay, you need to make sure this bottom line turn curve, then this should be your good entry point. Of course, you need to combine with some of the candlestick pattern. Remember, candlestick is downward trend. MACD is our trend, you need to follow the MACD, it might be going up. And vice versa. You can see that this is negative divergence or the bearish divergence. Bearish divergence is what we call when we want to do the short positions. For example, if the candlestick are in the bullish trends, but MACD is a downward trend, it's a time for us to consider short positions. But of course, when it's your good entry point, is you need to wait until the MACD turn curve. It's a very, very important stuff. So let me show you the example. So you can see that this is a beautiful divergence. Candlestick is an upward trend. The previous low is much lower than the current low, current high. So things happens, and then this is a downward trend line. Follow this blue color line. When this happens, and once this turn curve, okay, it's dropped aggressively. So this is one of the example. Another example on it. Later I will try to find some of the real life example for you. So let's see, we do have any good real life example. We can use this. But this divergent pattern, right, is actually not that easy for us to find. You need to note that because sometimes things might be quite different. So let's see. Gold price, right? Actually, there will be a chances for gold to form bearish divergence. There will be a chances. But you can see that this candlestick, right, is upward. You can see the MACD is downward. But you need to understand that maybe this is a good point for us to short, but you need to remember two things. US election is around the corner, and then we do have a lot of high impact economic data that is going to release. So even though this indicator shows some very, very good short positions, but you need to bear the risk that things happen fundamentally is going to affect the gold markets, no matter how good is the technical analysis, candlestick pattern analysis, things like that. And you also need to understand that this haven't turned curve, especially this blue one. It turned curve slightly, but not confirm one. Sometimes, right, you thought it's already curve, then it might turn going up. So you need further confirmation. It's better for you to wait until they turn the real curve lah. And then you can combine with the analysis like, okay, so now you notice that gold prices is actually testing the Fibonacci expansions level, the support level, 2776.90. We may name it at 2775 lah, testing here. So what is a good point for you to short? You combine with this candlestick breakout. If any potential breakout, and then if this thing turn curve, then there will be a chances for gold price to dropping further. But of course, we are not guru. I need to warn you that there are tons of things that are going to happen in the markets later this week. So even indicator price is good. You need to mind the risk management because no farm payroll is going to affect the market. US GDP report is going to affect the market. US core PC price index is data. This is all economics data. Is going to affect the market. So you need to aware and be careful on it. So this is an example of the MACD divergence. Others, I don't think a very good example. Maybe we can try to look through the oil. Oil have a good example lah. I show you here. You can see that oil, right, from here downward trend, right? Okay. But here you can notice here going up. So things happen going down here, continue to going up, and things turn curve. You can see that on price going up aggressively. But it's not very easy for us to find out. So when we find it, you can try, but you don't all in your money. It's a worth reminder for you because things change, especially by using. Here also a good example. MACD up. Do you notice it? You realize here going down, here going up. When it's turn curve, you can see that it's rebound back. So it's a very good indicator, but hard to find. And then even when you found it, don't all in your money. Here is also a good example. Okay, here is also have an example previously. Here candlestick upward trend line. MACD is downward trend line. See, when it's turn curve, going down. So this is the power of the divergence. You can try to play around it, but just try water. I think this is the most important indicator that you should learn in today's briefing, in today's webinar. Okay, I believe I already teach you some of the good indicator tools and then try to let you understand how can we analyze our report, because I understand that when we prepare this report for all of our clients able to access this report one. But sometimes it might be confusing. I don't understand what is MACD, what is RSI. That's why in today's webinar, we purposely create the topics to let you guys understand how to analyze this report and then enhance your trading journey in the future basis. But of course, in future basis, we will launch a more interesting webinar, including the ICT, the soup strategy that we are going to launch and teach you guys in future basis. This should be something more interesting and then more difficult and more useful. So stay tuned on it in the future basis. And then, yeah, I think this is all the most important things. And that's it. And then just a kind of reminder, we actually do have the Telegram group. Inside the Telegram group, we will normally update a very short market analysis movement. Then we will also let you understand a very, very good trade of the day that you can be focused on it. There are no advertisement inside on it. They are not forceful for you to deposit in order to enter the group. Is free. It's free, and then you can access to a lot of good analysis reports. So if you are interested, you can feel free to follow it. And we don't charge any of the money. Just note. You can notice that if you join the Telegram group, we will normally don't like give you some tier, like you need to deposit by how much, then you can enter like how. So feel free to join. It's a free learning tools, and then it can save your trading journey. All right, so that's it for the webinar today. We really hope that some of you guys are able to learn something today. And then thank you for staying with me for the whole hour. And then, yeah, thank you so much for the support. Now I'm going to open for Q&A sessions. Anything you guys want to ask me? If not, I think we are going to end our webinar right now. All right, I assume no questions. And once again, thank you so much for your support. And we're really glad that you keep supporting us and show us a very, very great encouragement. So if no more questions, we are going to end now. Thank you everyone for your time and have a good night. And Agni is actually asking, will we get this record? Yes, we will get the records after the webinar and we will send you the email. Thank you. Is glad that you feel this is quite helpful. And Mark Wood is actually asked, what is the best time frame? Normally for me, I think maybe H4 daily is a very, very good time frame, but it depends on what type of trader you are in. For example, you want to trade with after the data release, the post data release, then maybe you can use the 15-minute time frame. If you want to trade in a very long-term trader, then you can use H4 day one or weekly. Depends on what types of trader you are in. So you want to trade during the US elections, then you can utilize the H1 time frame, because every hour they will update the pool. The updating pool is going to affect the market. So depends on what type of news you are trying to trade with. You want to trade short term, then you use a short time frame. You want to trade a longer term, then you longer time frame for market. Okay, but for example, if you have work and then you don't want to keep monitoring the chart, then you just use the daily time frame. When in the morning you set your targets by using the daily time frame, you do a very small loss size instead of like suddenly do a very big loss size to have a good risk management, because you're going to hold for whole day. So you do the trade, then you go to work, and then by the end of the work, you're able to notice, see what should be the movement in. You don't have to keep monitoring the chart. But if you want to keep monitoring the chart, you want to do a very, very big profits things or loss now, of course, you need to use a shorter term time frame, but you can open with a bigger positions. I will answer your questions for Mahmoud. Any more questions? And yes, Henry, we will get the recording. Thank you so much for you to like the series tonight. Assume no more questions. I think we are going to end the webinar right now. And thank you everyone for your time and have a good day. Last question to answer, Henry. we will send you through the email for the recording. Thank you.